Most people don't realize they're trapped. They work every day, save every month, and yet by the time retirement hits, they barely have enough to scrape by. The truth is, if your money isn't making you money while you sleep, you're fighting a losing battle. But what if you could break free? Today, I want to walk you through something that can completely shift how you think about wealth, not just for you, but your kids, your grandkids, and everyone after them. I'll show you a step-by-step guide on how to build a dividend empire. And at the end of the video, I'm going to show you the exact dividend stocks and ETFs I've personally selected after running them through this entire process. These are the picks that made it into my own dividend empire, a portfolio built to pay out over $60,000 a year in dividends with only a one-time investment of $10,000. Every step I'm covering is part of what makes that kind of income possible. Let me show you what I mean. When I say dividend empire, I'm not just tossing around some catchy phrase. I'm talking about a strategy, a way of investing that creates a steady flow of income month after month, year after year, without you having to lift a finger after the groundwork is laid. Imagine this. Instead of selling stocks for profit or chasing the next hot stock, your portfolio literally pays you just for holding on to great companies. That is dividend investing. These are payments made by companies to shareholders, typically every quarter, just for owning a piece of their business. It's like collecting rent checks, but from the stock market. Now multiply that by years. Add in compound growth, reinvest those dividends, watch it snowball, and then imagine passing that portfolio down not just as a lump sum, but as a living, breathing income machine that keeps working for your family long after you're gone. That's the empire part. And listen, this isn't just reserved for the wealthy. You don't need six figures to get started. You just need patience, consistency, and the right strategy. And that's exactly what I'm about to break down for you, starting with why dividend investing beats nearly every other approach out there when it comes to building lasting wealth. Let's start there. All right, let's strip this down to basics because dividend investing isn't complicated, but it is powerful. When you invest in a company that pays dividends, you're essentially buying a small piece of that business that shares its profits with you. Every quarter, or sometimes every month, they send you a portion of their earnings. That is your dividend. And the best part? You don't have to sell anything to make money. You just collect it. Now, why does this beat most other strategies? Because while the stock market goes up and down, those dividend payments tend to keep coming, especially from well-established companies. They're reliable, predictable, and when you reinvest them, your money makes even more money, which then makes even more money. It's a compounding machine that gets faster and more powerful every year. So if you're looking for stability, growth, and freedom, dividend investing isn't just one option, it's one of the best. And it all begins with how you pick your stocks, starting with the ones that pay strong, sustainable dividends. Let's get into the real building blocks of your dividend empire. And it starts right here, strong dividend yields. Now, dividend yield might sound like a fancy finance term, but it's actually really simple. Think of it like this. If a stock is worth $100 and it pays you $4 every year in dividends, the dividend yield is 4%. That's your return just from owning the stock, even if the share price doesn't move an inch. Not bad, right? The key is to look for solid yields, not too low that they barely matter and not so high that they scream danger. Somewhere in that sweet spot, usually between 1% and 4%, is where most strong companies sit. These are the businesses that don't just pay dividends today, but have a track record of doing it for years and increasing them over time. But before you jump in and pick the ones that look the most generous, there's a trap many investors fall into, one that can ruin your entire strategy if you're not careful. Here's where things get tricky. You see a stock with a 9% dividend yield and your eyes light up. That's almost free money, you say to yourself. But hold on. This is the part where many investing portfolios collapse. That super high yield it might not be a gift. It might actually be a warning sign. These are what we call dividend traps, companies that offer tempting payouts to attract investors even when their business fundamentals don't support it. They're like restaurants handing out free meals while secretly bleeding money. Eventually, they either slash the dividend or collapse altogether. Either way, you're left holding the bag. To avoid this, you have to look beyond the yield. Ask, is the company consistently profitable? Have they grown or at least maintained dividends over time? What's their payout ratio? Are they spending all their earnings just to keep the dividend going? Basically, you need to look at the big picture when selecting stocks. Here, look at one of my picks, ProShares Ultra Dow 30 with the ticker symbol DDM. Now, DDM is a leveraged ETF, so it does come with some volatility, but if you zoom out and look at its 5-year price history, it's actually held a fairly strong upward trend, with a clear recovery after dips and a tendency to follow the Dow's overall growth, just amplified. More importantly, check its dividend history. Since 2021, payouts have been steady, and in the last couple of years, we've seen some of the highest quarterly distributions in over a decade. In 2023 alone, DDM paid a consistent 22 cents per quarter by the end of the year, and in 2024, that climbed even further, with payouts of 24 cents, 26 cents, and even 27 cents in a single quarter. And in 2025, the trend is continuing with a solid 25-cent plus dividend, showing that this fund is stepping up. This is what you want to see, a history of regular dividends, growing payouts, and price resilience over time. And speaking of lasting, if you want your dividend empire to thrive in all market conditions, you've got to think beyond single stocks. There's a smarter, safer way to grow. And remember, at the end of this video, I'm going to show you the exact dividend stocks and ETFs I've personally selected after running them through this entire process. These are the picks that made it into my own dividend empire, a portfolio built to pay out over $60,000 a year in dividends with only a one-time investment of $10,000. Building a dividend empire isn't about throwing all of your money into one golden goose stock. Even the best companies hit rough patches. That's why smart investors spread their bets. This is where diversification becomes your best friend. Diversification means owning a variety of assets so that if one struggles, others can carry the load. In dividend investing, that might mean holding stocks across different sectors like healthcare, utilities, finance, or even international markets. But you can also take it a step further with dividend-focused funds, like ETFs or mutual funds that are built specifically to pay out consistent dividends. These funds often hold dozens, sometimes hundreds of dividend-paying stocks. It's an easy way to get instant diversification managed by professionals while still collecting income. And here's the bonus. Some of these funds even reinvest dividends automatically, which brings us to the next move. Because if you want to turn income into serious long-term wealth, there's one habit that accelerates everything. And that's the real secret sauce. If you're collecting dividends and just spending them right away, you're only getting half the benefit. But if you reinvest them, in other words, buy more shares with those payments you receive, now you've got a compounding engine. Let's say you invest $100 into a stock that yields 4%. In the first year, you earn $4 in dividends. Instead of spending it, you reinvest it to buy more shares. Now your new investment isn't $100, it's $104. In the second year, you earn 4% on $104, which gives you about $4.16. You reinvest that too, making your total around $108.16. In the third year, you earn 4% on $108.16, giving you about $4.33. Again, you reinvest it, pushing your investment even higher to roughly $112.49. You see the pattern? Each year, your dividends get a little bigger because now you're earning dividends not just on your original $100, but on every payout you've reinvested. What starts as a small snowball slowly builds more speed and size, and over time turns into a powerful machine for growing your wealth. Take a look at this graph. Each step up in the investment, from $100 to $139, reflects compounding through reinvestment. But here's what's even more interesting. Your effective yield grows with it, from 4% to over 6%. This is how a modest portfolio turns into a massive income machine over time. And once that compounding machine is running, that's when it's time to fuel it with the right players, companies and funds that don't just pay, but grow. So let's break down exactly what to look for when choosing them. At this point, you've got the engine. Now you need the fuel. The companies and funds you choose will determine whether your dividend empire crawls or rockets forward. First, you want steady dividend payers, companies with a proven track record of paying dividends not just regularly, but consistently increasing them. These are often referred to as dividend aristocrats or dividend kings. They've raised their payouts for 10, 20, sometimes 50+ years straight. That kind of consistency tells you two things. One, the company is likely financially healthy. And two, they prioritize rewarding shareholders. But don't stop there. Look for unique opportunities too. Sometimes a company is undervalued because the market just isn't paying attention. Maybe it's in a boring industry or a foreign market. That doesn't mean it's a bad investment. In fact, these often provide the best blend of dividend yield and growth potential if you're willing to look deeper. And remember, funds can also play this role. Dividend ETFs like the ones I'll cover shortly give you diversified exposure to dozens of these companies in a single investment. It's like buying a basket instead of picking apples one by one. Now, once you've built this powerhouse portfolio, how do you make sure it outlives you? Because true wealth isn't just about money, it's about what you leave behind. Building an income machine is one thing. Making sure your family knows how to use it, well, that's where the real legacy begins. If you want your dividend empire to serve not just you, but your kids and grandkids, you need to set up the right systems to pass it on. That can be as simple as setting up a custodial account for minors, where you control the investments until they're of age. Or you might consider a trust account, more complex but incredibly effective if you're thinking long-term and want control over how the money is used even after you're gone. But tools are only part of it. The bigger piece? Teach your family how and why this portfolio works. Sit down with them, walk them through the income flow, explain reinvestment, help them understand that this isn't a lottery ticket, it's a system. Because passing down money is easy. Passing down values, discipline, and strategy, that's what turns wealth into legacy. And now that we've laid the foundation, picked the right players, and ensured the future, let me show you what it actually looks like with a real-world portfolio built using everything we've talked about so far. Here's a sample portfolio built with intention, designed to grow, and made to pay. These 5 picks blend steady dividend income, long-term capital appreciation, and solid dividend growth. Each one fits the principles we've just covered. Take the Global X MSCI Argentina ETF. It gives you international exposure and has strong capital growth potential with a forward yield of 2.21%. Northrim Bancorp is a lesser-known bank with a 3.39% yield and a history of healthy dividend increases. ProShares Ultra Dow 30 gives a double-leveraged growth angle. United Health Group is a blue-chip healthcare giant with nearly 19% dividend growth. And Fastenal is a long-term dividend grower with strong fundamentals. Now, here's how you can calculate your portfolio metrics, growth, etc. To calculate the average dividend yield for this entire portfolio, you first add up the dividend yields of all 5 investments. ARGT has a yield of 2.21%, NRIM has 3.39%, DDM has 1.22%, UNH offers 1.97%, and FAST has 2.16%. Adding these together gives us a total of 10.95%. Since the portfolio has 5 stocks, we divide that 10.95% by 5, resulting in an average dividend yield of 2.19%. This method assumes an equal amount of investment in each stock. If different amounts were invested in each, we would need to use a weighted average instead. But for an evenly balanced portfolio, the average yield comes out to 2.19%, offering a steady foundation for both income and growth. Now, mathematically, you can do the same for average dividend growth, which comes to around 17.17%, and average share price appreciation, which adds to about 13.52%. Now comes the real question. How much can this portfolio grow your one-time investment of $10,000? Let's run the numbers. Let's say John puts $10,000 into this portfolio using the exact strategy we've just walked through. No fancy tricks, no constant trading, just solid dividend-paying assets, dividend reinvestment, and time. After just 1 year, his portfolio will grow to $11,571. By year 10, his portfolio would be $44,521. Year 20 is where things really take off. His account will grow to $218,079. That's more than a 21 times return. Give it 10 more years, and by year 30, his original $10,000 with dividend reinvestments will be valued at $1,222,742. At that time, it would be paying around $63,229 in annual dividend income, or about $5,269 in monthly dividend income. You can start using the dividends for expenses, or you can allow it a couple more years, and it'll pay over $10,000 in monthly dividend income. The total value added to John's portfolio will be $1,212,742. And out of that, over $336,968 came directly from dividend income, while the rest, a massive $875,773, came from steady, consistent appreciation. This is what it means to build a dividend empire. It's not flashy, it doesn't happen overnight, but it works, and it works with math. Don't have the initial $10,000? Click the video on the screen to find out how to make $6,000 a month with only $20 a week.